Once again, people are saying that we're very likely to see interest rate cuts in September, and just because of that, too many people are already assuming that things will escalate directly from there. But we need to look at this much more deeply, because the past has shown that interest rate cuts alone are not always enough to drive prices higher. In some cases, those interest rate cuts actually led to significant drops in the stock and crypto markets, which is why it's important to consider several factors here. And that's exactly what we're going to take a close look at now. We'll examine where the parallels are to previous cycles, because I believe that's much more important than simply saying interest rate cuts are coming, so everything is going to skyrocket. We need to stay rational here. So go ahead and leave a like and a comment now. You know that really helps me out a lot. So I want to thank you in advance for that. In this cycle alone, we've already had 5 sideways phases. They're getting more and more intense, and it looks like we're currently in the 6th sideways phase right now. And it just looks that way because in every sideways phase, we've had an upward trend, then a correction, almost formed a double top here, and then corrected down again. Even in the last one, just take a look. We formed a top here, then another double top, and after that, this long sideways phase that lasted over 200 days. We formed a top here, and now we've built another double top. And now it looks like this could really be the next sideways phase for Bitcoin. But you have to look at the whole thing from a longer term perspective, because just because we see interest rate cuts starting September 17th, that doesn't mean things will immediately skyrocket from there. The thing with the interest rate cuts is super cool. However, we've simply seen that even with interest rate cuts, we've often experienced some really hefty correction phases. Except here in 2019 and 2020. There, we saw significant interest rate cuts and only had a minor crash afterwards, but in the long run, things really took off. Now, you have to understand why. This was the Corona crash anyway, but during the Corona crash, interest rates were quickly lowered and a lot of capital was pumped into the markets. Because interest rate cuts alone are not enough. In the end, it all depends on the Federal Reserve's monetary policy. We can see that very clearly here as well. Starting in 2020, just look at how much money was put into circulation here. Here we had quantitative easing, and as a result, an extreme amount of capital flowed into the market. And in the end, that ensured that, despite the interest rate cuts, we saw a really strong increase. It was different, for example, here in 2007 and 2008 during the financial crisis. Interest rate cuts, and we corrected downward. If we now look over here at the Fed balance sheet, we can clearly see that from the point where the Fed balance sheet just stagnated, the stock market also completely stagnated and moved sideways. Or rather, we had 2 or 3 years in the S&P 500 where almost nothing happened. We had the same thing in 2001. So accordingly, interest rate cuts, yes, they're cool, they're nice, but that also has to go hand in hand with an easy monetary policy from the Federal Reserve. And as you can see for yourselves right now, that's not the case at all. We still have a restrictive monetary policy, and that needs to change. And ideally, it will change starting from September 17th. That would be positive. But as I said, you definitely have to keep the balance sheet in mind, because that's also tied to the money supply, and you can see very clearly that while we've been rising steadily here, especially in 2020 during the COVID bubble, a huge amount of capital was pumped into the markets so that the stock markets wouldn't collapse. They tried to save the economy. They only managed to do that with new money. I've illustrated this for you here as well. The US dollar M2 money supply, as it grows bit by bit year after year, quite normally, but right here we see an extreme jump. Between 2019 and 2022, we saw a very sharp increase, much more dramatic than in the previous years. And in the end, that naturally boosted all markets, everything. Accordingly, a loose monetary policy is extremely important for every cycle. What's also important is to simply overlay the cycles and see what is happening here. And here we see in white, our current cycle is actually quite weak in comparison. And if we set that aside, we see that we're running relatively similarly to the 2017 cycle. And now you have to think, who was president in 2017? That's right, Donald Trump. And with the Democrats and Republicans, it actually always goes the same way. It's really crazy. Obama, a Democrat, ever since he was elected, he has strengthened the dollar. Trump, a Republican, since he became president here in 2017, he weakened the dollar. Joe Biden has strengthened the dollar, Trump has weakened the dollar. So you can see how crazy it actually is, that it really just depends on which party is currently in power, whether they strengthen or weaken the dollar. And with Trump, we can see very clearly he weakens the dollar. That's also his goal, so that better trade and so on can be conducted. Accordingly, this cycle is now running exactly the same as the cycle in 2017 because we simply have the same president, the same mechanisms, and the same monetary policy. And if we take another look at this here, it becomes even clearer because here in red we have the 2013 bull run. Here, the 2017 bull run, 22, and our current one. We see, when we compare this, that we are building up step by step, just like in 2017. We didn't have really big spikes here, like here or here. We built up continuously here. But for that, the bull run also lasted longer. In 2021, this euphoria phase and everything went a bit faster, but much more rapidly. There we built up step by step. You can see up here that there was simply much more volatility, and we performed extremely strongly in a very short time. And we can clearly see that we are currently moving exactly like we did in 2017. And while some people are still worrying here, what could this look like now? Or, what could this look like now? What about this? You can simply take a look at how the P-cycle top indicator is behaving. The longer we stay in these good price ranges, the higher the price targets become. Our P-cycle top indicator is at $180,000. That's insane, and it keeps building up more and more. And back then, it didn't stop when we broke through it. It kept going further. And that's what you need to understand here. For the euphoria phase, we first have to break through the P-cycle top indicator, and that means in this bull run, we need to see $180,000 and above. And that's why it's not all that negative if the whole thing drags out a bit. It's simply dragging out like this, because we're seeing exactly the same mechanisms as in 2017 with Donald Trump. And if you zoom out here and look at the 2017 cycle, it looks as if it just kept rising straight through. But what you have to clearly say is that even here, we repeatedly had corrections, especially from August to September, a correction of nearly 40%. And that's why you should always be prepared, because corrections are a completely normal part of it. Here, a correction of 35%, and here, another correction of 30%. All these corrections were part of the journey upward. Only in this last really intense phase does it get truly wild again. But as I said, corrections of 30% were also completely normal in the 2017 cycle, but the more you zoom out, the less you notice them. And it will be the same in this cycle. But of course, what has to be said is that we can clearly see it's getting tighter, for example with Bitcoin dominance. Because there were times when Bitcoin dominance corrected for over 12 months, then in the last cycle, it only corrected for 9 months. Now we see that we've had a very long Bitcoin phase. That means, based on time and data, we really only have about 3 or 4 months left where Bitcoin dominance can gradually decrease, and then we could see another altcoin season. But this time window for the altcoin season is simply getting tighter and tighter, and that's a fact. And even when we have these sideways phases, you can still make good money in between. At times, we've already had smaller altcoin seasons during these phases. I mean, this rise here, we were a bit overheated on the RSI, that was just a little mini altcoin season as well. Here, it's exactly the same, slightly overheated, mini alt season. Right now, we're a bit overheated again. This could be the next smaller altcoin season, because if we switch over to the altcoin chart, we can see that this first phase really pumped a lot of money into the altcoins. The second phase was the same. We were only able to experience that because, at that point, the RSI for Bitcoin was temporarily overheated. And that's why you can say that we're currently in a phase again where maybe some capital will be shifted into altcoins, and that the next few weeks could actually be a good time for altcoins, because we're overheated here again, and every time that's happened, we've seen a bigger upward trend in the alts. And these sideways phases have simply become a normal part of it by now. You have to learn to deal with it, but as I said, in the long run, they actually do us good and don't harm us. And with that, thanks for watching, friends. You know what to do. See you next time. Ciao.